Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, February 5th, 2024. It's 10:43 a.m. Eastern Time, so I'm starting the video, so we're about an hour into the trading day. And here's what I want to do in this one. The markets, I want to stick with that for now. That's my main focus at this point in time. I'll try to show you a few new things and kind of touch on some of the other things I've been highlighting recently. So here's how we're going to do this. In case you want to skip ahead to something, I'm going to cover the indexes first. We're going to look at the large caps and the small caps, and then the large caps we'll dig down, not a lot, but we'll look at the two main ones I follow, which are the S&P 500 and NASDAQ 100. Again, the Dow is only 30 stocks, so I like to, watch the S&P for kind of overall feel for where the market's going, and then QQQ because it's more of a preferred trading proxy, just a little more juice in there because it's more concentrated into tech stocks. But then I want to look at the equal weighteds. Then we'll go to the small caps after doing the large caps. Then the VIX. Definitely want to do an update there. And then the semis. Lot of comments. I'm going to talk on that real quick. I took a look this morning, and the last video I did, I guess it was Friday, and I'll tell you what, I don't believe ever in years, decades actually doing this, that I've ever posted, the top is in. But after reading the comments on Friday, at least if that, I've always used the comments on the site as kind of an indicator, both, bullish, bearish, contrary, when things reach extremes. It's really no different from the sentiment indicators, put to call ratios, things like that. But boy, if it ever feels like a top is in or very, very near, and again, maybe it's just a handful of people, but that whole market's going to go up forever. It doesn't matter. Divergences don't count anymore. The big Mag 7 can lift. So, and then on that real quick, I'm going to address this, and that's why I want to get to the semis at the end. It kind of prompted me to do what I'm going to do, and this is something a little different. Look at the semiconductor sector. And I did this to an extent a couple weeks ago when I covered them exclusively in one video, but I'm going to show you that the semis, because that's where I see some comments pointed at, NVIDIA to the moon and all this, are really, when you dig down in the sector, it's painting the same exact picture that the stock market, the S&P 500, and especially the NASDAQ 100 are painting. And that's fewer and fewer and fewer stocks doing the heavy lifting. And again, guys, I've done this a long enough time that's, inevitable or nearly inevitable. Sometimes maybe the market breadth picks up, but usually it's a signature of a top when breadth starts to really noticeably decline, and fewer and fewer stocks are doing the lifting. And again, it's an indication of what's going on. It's not a timing indicator. What are timing indicators? I'm going to get to that again. I'm going to reiterate, because when I look at the comment section, you would think that I'm long NVIDIA, short Meta. Somebody mentioned, for example, put Meta as a short sometime last year. If I did, I remember we had several trades long and short on a lot of tech stocks in the last year or so. When you look at QQQ, for example, there was quite a few shorts and also longs, but I don't, hear any of these folks talking about being long Apple right here. And I'm not long Apple anymore, but that was one of my top picks, long all the fangs there, right there. All the two biggest inflection points in the market. And again, I'm not long Apple, as I'm not short Meta that I shorted back here. But it's the same logic. So just keep that in mind. If trades, number one, there's a big difference, ginormous difference between an actionable trade idea that is triggered and a trade setup. Because I can and have been talking for a long time where I think this market's going, where I think the semis are going, and until you get the sell signals, and I've also for months, even going into last year, given the levels that I think will be that, what I call that all-in moment, or when the odds, in my opinion, go substantially higher, that we are going to take out the lows from 2022 or 2023. All right, so let me get into just a quick overview of the markets. This is QQQ. This is a daily chart here. I'm just going to hit, as I like to do, the salient levels. Here's that uptrend line, which again, I mentioned the other day. If anything, you go long at support. We hit the trend line. It never broke, and it needs to break. So on QQQ, again, that's when we'll have a sell signal on a break of the uptrend line, which is the same as this, this bearish rising wedge here. There's your divergences and all that. And then you also have just below it what I call the BOD, or benefit of the doubt, support at about 413.74. Zoom in real tight. Let me tighten the lines up here to capture those candles. There it is. This previous high right here, reaction high. And this was our breakout candle. So right now we broke out the new highs. And again, QQQ will provide an objective short if and when this trend line is clearly taken out, and even better, maybe a partial position then, because at that point you could still just get a simple back test of the breakout and then go on and eventually maybe even take out these divergences. As of now, that's not the case. We still very much have them intact. And then 413, and then that's going to open a door to these targets for 395, and then the big levels, my purple lines, 380, about 384. There's a gap there. It's really the bottom one, 378. If I turn off all the lines, I'm going to show you why. That's the big one. 378 is right. Let me put a line up on it. No, then all my lines come back. Can't do it that way. Let me take that one away. 370, it's that gap right there. So I'll turn everything off. I'll just hand draw it. 378 is this, the bottom of this gap. And you can see over time, if we start to correct down that way, it's going to come in around these 200-day moving averages, which haven't been visited in a long time. As I scroll back, you can see in a bull trend, they act as support. A lot of this is stuff I go over all the time. Once you break them in a bear trend, they become support and remain support in a bull trend. And in a bear market, once you break them, then you're in a bear trend. You short rallies back to the 200s and so forth and so on. And you can go back in time, and I encourage you to do this. I talk about these all the time. They're not the be-all, end-all 200 moving averages, but they're big ones. And they work very well for tech stocks and the tech sector. If you go to a weekly chart, put up a 40-period exponential moving average, or simple. I have them both. That's why I have the blue and red lines. And you can see they define all the bull and bear markets. In bull markets, you're above there. Bear markets, you're below there. So that's what we're looking for. And so at the very least, even in a bull market, you come back to visit those levels all the time. And then ultimately, they break. And when do they break? Well, typically after you have these conditions, extreme bullish sentiment, negative divergences like this one, overbought conditions, everything that you see, all these divergent highs. Each and every time we took out the 200s and we had a bear market or a correction, if you want to call it that, drops of double-digit drops, it was preceded by clear negative divergence that we have now. So I know there's a small but growing, very vocal contingent on the comment section. But my views, nothing's changed. Nothing's changed in the technicals. In fact, we have a nice setup today. I got that post out to you. Meta has just what appears to be a textbook looking exhaustion gap. Only time will tell. And I gave you a couple ways to trade it if you're so inclined. I know, based on the board, a lot of you say just keep buying because the market's going to go up. Doesn't matter for a while. It's an election year, blah, blah, blah. But like I said, you can either take the a break or an entry of the gap. The gap is right here. Technically, the gap is defined as where you opened and closed previously. You can do that. I like to, be safe, wait for a break of Friday's low. It's not much below that. And the point is, usually once you enter a gap, very often that gap isn't going to be backfilled. So even that in itself would be a monster trade. I think the stock was up like 20% or whatever on Friday. And I also said, look, a more aggressive, the most aggressive option, because there are absolutely zero sell signals now, but it's, like I say, a great RR. And just to reiterate, again, we were not short, and I have not posted. I posted many short setups on Meta, and that was to break below this primary, the white uptrend line. I'm going to draw it for you here because I know my boards are getting pretty busy. I started to call out some of the levels, take them out, but that's the trend line. and it's still not broken. And that's a big sell signal when that one's taken out. It's a very well-defined, powerful trend line. It'll probably take us down at least to the 200s. Yeah, I gave you some arrow breaks on that chart I gave you today, roughly where the big levels are. I know I didn't have all the, I posted a clean chart for you. It didn't have a lot of the horizontal price levels. I just wanted to focus on those gaps. And so that's it. So again, pretty clean gaps, your breakaway gap, continuation gap, and potential exhaustion gap. So we'll see. Depends where we go in the coming days to weeks. Could you exceed this high? Yeah, you could still do that and go down. But again, if you're going to take the aggressive entry, my suggestion would be keep stops tight. You can always get back in. And then the little less aggressive is to wait for an entry of the gap or the stock to enter the gap. And then the other, kind of much higher probability entry is wait for a break of the trend line. Now, the problem is not a problem per se because the downside potential is still huge, but that trend line, just to get down there from where we're at, it's got to drop about, 16, 17% just to get to the trend line and then a little more down below there. So let's not spend too much time on metal. Let's just go to look at the indexes. So in summary, QQQ, the uptrend line, which is still very much intact, the primary uptrend line. We did have one there, and we did have a sell signal there. It turned, and it was good for a tradable bounce, or tradable pullback, excuse me. And now we've gone up, and now this is a more significant, a longer, more well-defined trend line, lots of clean reactions, and your divergence line right there. And so there's your BOD level. So those are your next sell signals unless we get some type of candlestick reversal pattern on QQQ. Since there's no resistance really per se, other than very minor resistance would be the recent highs. You can see QQQ is kind of stalling out here at about 430.10. So you could make a case there, but again, these are your higher probability entries on QQQ. There's the weekly chart, big negative divergence. And now let's look at one other thing here. On the PPO, I'm going to cover this on all of them, so I'm going to throw up the PPO histogram right now. We just made a bearish cross recent. The hill was medium size, not too big, but I just want to point that out. But now let's look at the equal weighted indexes real quick. QQQE. There it is. No, that's not it. Yeah, that is it. QQQE. Nice and clean. You can see here we had this initial trend line right here off the lows. We broke it. We got a nice pullback, definitely tradable pullback. Reversed a little shy of that breakout. There's your breakout candle right here. Again, this green candle was a breakout above that high. And we came in and we pretty much back tested it, moved higher. But you can see now we have really a nice setup here with a rising wedge. Again, a trend line just like QQQ that has not been broken, but will trigger at least for the equal weighted. You want to increase the odds, wait for both the equal weighted and the regular weighted NASDAQ 100 to break. There's also, I'm going to put it right here. There's your BOD line because there's a previous reaction high. And see, we back tested it. And so really, look, it's simple right here. You got to just take out these recent lows. That should open the door for a move back down. And I think ultimately back down to these 200 days at least. But first things first, we're going to break support as support until unless broken. But I just want to show you what it looks like on the equal weighted. And it's these negative divergences that say there's a very high probability it will break down. And those are pretty good divergences. The last time we had divergences of that scope was on the right here. And we had this, double-digit drop down into those lows, in which I posted time to cover all shorts on that personally and go long, which we did. So many seem to forget about that too. Again, this is swing trading, guys. I keep talking about the bigger picture, where I think things are going, 40, 50% downside in a lot of the indexes and many key stocks. But you got to take out the 200 days. You got to get below the trend. You got to take out those purple lines. And so right now, I'm just looking today, tomorrow, next week is first things first. Let's see if we get a sell signal here. And if you're bullish, the same levels I'm showing you are the support levels that I'm looking to make a case to add to short positions or initiate short positions are the same levels that you as a bull would want to buy, because that's what you do in a bullish trend. When you're long or looking to get long, you buy pullbacks to support or breakouts above resistance. Those are your two objective times to go long. All right, so that's equal weighted. And then when you look at the weekly chart, same thing, just put the lines back on here. There's your big divergence that you have. I didn't have it marked up. Last time we had a divergent high like that was right here, heading into the end of 2021, early 2022, and the equal weighted NASDAQ fell by 36%. Time before that, we had negative divergence on the weekly, just on the RSI, but that was the COVID drop. Right there was your previous divergence, et cetera, et cetera. So that's what the equal weighted look like. Again, divergence is overbought, but no sell signals yet on the NASDAQ 100. S&P 500, we're on a weekly time frame. Big divergence has been building, really since that high. We had a divergent high back then when the markets topped in the beginning of 2022, followed by the drop down here, hit the first long-term target, and I still have additional long-term targets that have yet to be hit. And the divergence from then has only gotten bigger. In fact, this is a ever so slightly marginal new high with the indicators making lower highs. It's still just a much bigger. You just have to roll back. You can look at it even on a monthly chart. You can see that divergence there very, very clear. And that indicates, again, that's what helps formulate the projections. This coupled with the fundamental case, when you really dig down and look at some of the, I don't want to call them more obscure indicators, but the ones not being talked about much, debt to income charts right now, the delinquency rate on loans, both prime and subprime, auto loans, things like that. There's just a lot of it out there saying that there's going to be a domino effect when this thing cracks. And again, you have the levels that we need to take out to increase the odds that we're going to go down to those deeper targets. But right now in the near term, again, if you put that aside, kind of shelf it if you want to, this is the most important thing to watch in the near to intermediate term. Just like QQQ, you have this nice clean uptrend line or bearish rising wedge, very clean and distinct negative divergence. The last time we had a comparable setup was right here, same bearish rising wedge, very similar, right? And from there, the S&P dropped. That was at 469 down to right there, 11%. We were short it. We were short on the breakdown, really via QQQ, and covered our shorts there and went long because of the positive divergence and the fact we fell and hit that second target. Remember, it was really about QQQ. T2 was hit right there, and all my purple lines, or the majority of my purple lines on all those key stocks. So that's where we're at. RSP, the equal weighted S&P 500. This is a daily chart, still well off its previous bull market highs right there. And again, I've covered this in detail, as are the vast majority of stocks, of the universe of stocks out there. Fewer and fewer are in a bull market or at or near or above all-time highs. And really, it's not just the Mag 7, but again, there's been numerous articles written that give you the percentages that they've attributed to, and it's so that's the new highs in the NASDAQ 100 and S&P are very largely attributed to those. But RSP, the equal weighted S&P 500, there it is. You're not far off that high. What is it? Let me measure it for you here. It's about, right now we're about 5% off the previous bull market highs. But you can see we've got some pretty significant divergences. And if I put up the PPO histogram, this one, remember, it flipped red back here. These are these hills I talk about. And it was poised to make a bullish cross, but failed to do so. So far, keeping that trend intact. Just like right here, you can see it came back. Here, I'll zoom in. During this bear trend, it came back to the zero line. Looked like it was going to make a cross, but also ran into the 200-day exponential moving average, got rejected, and kept that bear trend going. There was another leg down So I just want to point that out. That one is still in sell territory, at least by that indicator. And what you have now is some pretty decent negative divergences that if they do play out, that'll probably send us back down. At minimum, I'll put up another level. I mean, most people aren't trading this one anyways. I use it mainly to just kind of show what's going on under the hood in the market. But yeah, that would most likely send us down to at least here. And then there's that yellow line, which is very important as well, about 146. Let me park the histogram. So those are the large caps, equal weighted and regular. And then you have the small caps. Now, again, to be clear to those out there, so what are active shorts and which were highlighted as objective and actionable short entries in short trades recently were the small caps, both before the breakout even occurred, predicting it would probably be a false failed breakout, which it was. Then you fell back below the top of the trading range, about 199, 200. That was your second and more conventional or conservative short entry. Then you took out the trend line right there. And then most recently, I highlighted several days here as we were back testing the top of the range. And so this one, depending if and when you shorted it, at minimum, most of the short entries were, highlighted here at about the 200 level. And so that's up, nothing much, 4%. But and so this one is, profitable, and you can see the small caps continue to fall as just a handful of stocks, large cap tech stocks go up. And again, this one was, not you can trade any way you want, but I didn't put this out there as a short-term swing trade. It was put out as a typical swing or trend trade, again with a minimum target of the bottom of the zone. I have two levels there, really about 170 sometimes does the trick, but then the true bottom is about 163. And again, I said before it even happened that it probably would happen, and when it does, because you get those failed breakouts, usually the next stop, not straight down, you're going to zigzag down, but usually the next stop, once you have that run to the top, especially with a false breakout, is the bottom of the zone. And then ultimately, this thing will break one way or another. You're not going to trade sideways in the small caps forever. And so really the target for this entry is, these are multiple targets. And me as an active trader, almost, again, depending on if and when we get there, and the charts confirm, I'll almost most likely be gaming a bounce. But again, I don't know. If it depends how things look. If we're coming down hard into there and can't make a case to step in and buy, I might even hold my nose and ride out a bounce because I think the next time we get down there, I think you're probably going to see just a waterfall, maybe a brief blip, but I'd still maintain, bottom line is, whether we bounce there or not, I maintain this 144.20-ish and primary uptrend line right there as the next target on the small caps. And it's simple. Again, maybe I'm wrong. And the trade was super easy. You can either have a stop right there, you can have a stop above 200, or you can give the wider stop if you are targeting those longer term targets like I talked about above that 2850. That's the bottom of this very well-defined trading range. And we all know what happened once that one had the false breakout at the top. And then boom, straight to the bottom. Had one more bounce off the bottom of the range, then broke. Okay, so there's your updates on the equity markets. Still waiting for some sell signals on SPY and QQQ via the breaks of the trend lines, the uptrend lines, or the wedges on the daily. You can also see those wedges very well on the 60-minute chart. As if you want to kind of get an early start on it. It's this yellow uptrend line right here on QQQ. There's our, most recent high is just about an equal or slightly higher high. And you can see these indicators continue to diverge. But as I often say, and I'll say it every day because the same folks don't seem to hear it, divergence is not a sell signal. It is a condition. Overbought is not a sell signal. It is a condition. But when you have divergences, negative divergences and overbought conditions followed with a very clean uptrend line or a bearish chart pattern, such as a bearish rising wedge, that is a sell signal if and when that is broken. So, and then of course a failed breakout. So really the big level here on this 60-minute chart is about 413 right there. You can see we hit it, pulled back, hit it, pulled back, hit it, pulled back, and that was that breakout candle on the daily I showed you right here. So right now, this is nothing more, as would this be, than a back test. So that's why this is the BOD level. And sometimes I'll undercut it slightly, but quite often, based on the technical posture, whether we have a little slight bounce there or not, doesn't change where it looks like things are going for me. Alrighty, that is small and large caps. Let's talk the VIX. I've been talking about the VIX for a while, but not every day. Let's go to the weekly chart here first. This is the VIX Volatility Index. As I've mentioned many times in the past, this is where the previous bear market ended. This was the dot-com bubble, which popped in 2000. And then you can see the VIX spiked to that range a couple times, as it did on the corrections before that. This was the Asian contagion back in 1998. It was a big drop in the market. I think it was over 20%, but it was pretty quick and the markets rallied back. But you can see that was the ceiling back then on the VIX, and that's where the bear market ended. We started a new bull market, which ended in 07. It was actually the market itself peaked in October of 07, but the VIX bottomed first. The VIX tends to have quite often predictive values. And it didn't just randomly bottom. It bottomed with big positive divergence. Remember, the VIX is going to be a mirror image, inverse image of the stock market. And then that was it. So volatility started to go up. Along with the stock market, the VIX was rising. Stock market peaked in October of 07. And then we all know what happened. That was the financial crisis. This is where, like I said, from 2009 to 2021, that's where bull market corrections, I call them corrections, because everything really since 2009 to up to now, you want to consider it that way, or up until the beginning of 2022, late 2021, they were just really corrections. Even the ones that were double digits, we'll call them that. But that's where those ended. But this is where the Great Recession ended. That 55+% bear market in 2007 to 2009. There was the COVID bear market, 36% drop in the S&P. Was short over before, almost before it started, 6-week bear market, but yet it was 36% drop. And that's where it ended. So this time around, when the markets bottomed in 2022, we weren't even up to the this level here. And it just goes to show there's no fear. There was no fear. So it is possible. It is very possible that the bear market ended back in October 2022. I put the odds at very, very low. And if that is the case, it would be an extremely atypical bear market to not have any of the signs, a selling climax, indicative of volume, the last, plunge out, sentiment indicator. Some of those hit, buy levels, but collectively, including the VIX, we didn't get to where we, indicates the bear market's over. Okay, but that was then, and it is worth noting, but this is now. What do we have now? Nice positive divergence. The last time we had on the VIX weekly, I'm circling the divergences, was right here. And from that point, and that was 2021. And we got that spike out of the VIX. And so we have a similar technical posture. And right now we're at this pretty decent support. This is a support zone here that runs from about 1150 down to 1023-ish. And then you have this extreme. There were only two spikes down to that very extreme 850-ish level right there, right before that bear market started in 2007, and then right here in 2018. So there's the VIX from a weekly, and here's what it looks like on a daily chart. Still moving up. This was our most recent divergent low. It's just an extension of this divergence right here. We had a divergent low there, and the VIX spiked 81%. We have a divergent low here, and it's even bigger. You can see this divergence has been building. So this, of course, is like a mirror of the S&P 500 and NASDAQ 100 with their negative divergences. And so do they have to play out? No, there's no guarantee. Do they usually play out? Yes. And that's what I trade in, not possibilities, probabilities. And the probability says these will probably play out. What do we need to see happen? 1573. I think that's the magic number. I have was support here, a few spikes below, but again, more reactions when I looked. That's why I had the line there. Support there, broke under resistance, then we got above it. Again, enough reactions that I think that'll do the trick when the VIX pops that level to spike us up to some of these higher targets. But I'll say this, that is very unlikely to happen until and unless SPY and QQQ trigger those sell signals that I talked about earlier in this video. Okay, on to the next one. Let's go to the semis. What I'm going to do here is talk about, and that was another one, NVIDIA. I honestly, I don't remember any show. I keep talking about NVIDIA where I think it's going. But we need sell signals on the video, which we don't have. My purple lines are way down here. This one's out at all-time highs. Again, it's the poster child. Until they break this whole sector, it's not going to roll over. So just because I'm not long this stock doesn't mean I'm short it. And I just want to make that clear, because you read the comments, you think I'm short this stock and been short this stock for the last 200% or so. But there's your levels. The purple levels are way down here. But you still have big divergence. You can see it here on this daily. It shows better on the weekly when you see big divergences. And again, I've covered this chart a dozen times. I'll cover it again. This is a weekly chart. These are all the divergent highs. This was shared before this last drop. I gave you 3 targets leading into the end of 2021, early 2022. But previous divergent highs took this stock down 90%, 86, 56, 69, and you can see my next target, we hit T2, in which case I was covering positions there, covering shorts, posting it, going long, hit T2 and bounce, and I still maintain T3, which will be about, I might have to change the number. That's why I have question marks there. I had 86. Now it's going to be, if hit, it's going to be about 90%. So we're going to, off the highs. And really nothing's changed. The stock is in an uptrend, well above its moving averages, trend lines, no sell signals yet. You can see the uptrend line that needs to go. And that'll be a high probability sell signal. A daily, and especially, this is a weekly chart, a solid weekly close below that will, in my opinion, increase the odds of that drop down to that next target substantially. Negative divergence, but it's not confirmed. Indicators are still pointing up. So as long as it rises, I'll move this line. And one day I won't be able to move this line anymore if it exceeds that. However, here's what I'm going to show you on the semis. NVIDIA is one of the Mag 7, and it is by far, without a distant second, the largest semi. It's almost its own thing. It is, you can see here on my watch list here on stocks, it is right here, hopefully you can make that out in the video, $1.6 trillion market cap stock. Taiwan Semi, next largest holding in SOXX, is only 588 billion. And then it goes down from there. So you can see that one's nearly 3 times the size of the next largest holding in SOXX. However, let's do this, guys. Here's what I want to show you, and we're going to wrap the video with this, because I've done quite a bit lately on market breadth, and I've talked quite a bit, as others have, that it's the Mag 7 or now the Mag 5, whatever you want to call it. Fewer and fewer stocks doing the bulk of the lifting of the indexes, giving the stock market a false guise of strength. Again, you look under the hood, and as I've done some pretty in-depth videos on market breadth recently, looking at percentage stocks above their 200-day moving averages, 50-day moving averages, advancing decline lines, all that good stuff. We're going to do it here in the semis very quickly. So in the last video, or the last couple videos I covered recently, I mentioned there are 3 main semiconductor ETFs: SOXX, XSD, and SMH. And I said XSD, that's X-Ray, Sam, David, whatever. Of the 3 is by far the most diversified. It's the Spiders S&P Semiconductor ETF. And as you can see over here, and this is what we're going to go over real quickly, you have a total of 39, at least this charting platform is telling me there's 39 components in there, and I have them right now ranked by market cap. And just like the NASDAQ 100, if you go through those, you're going to see the same thing. You're going to see the biggest ones, particularly NVIDIA, strong and at or near all-time highs, multi-year highs. Okay, sorry, I had a phone call there. I had to pause it for a second. So there's NVIDIA, and I'm just going to walk through. We're not going to go through all 38, no need, or all 39 components. No need to do that. I'm just going to make a point. Again, the same conditions, if you will, that the NASDAQ 100, even the S&P 500, this stock market itself has, with fewer and fewer mega caps sucking in all the cash right now, doing all the heavy lifting. You can see the same effect here in the semiconductor sector. So there's NVIDIA, Broadcom's number 2, and all of them have the same, the ones that are at the highs, the ones that are dragging or pulling, if you will, the semiconductor sector up, have similar technical postures. And it doesn't look like much. I use log scaling on my chart. I'm just going to measure out. Let me just make a point before we have 1, 2, 3. All right, let me go over these real quick just to kind of show you where those 3 divergent highs. This is a weekly chart we're on, remember. That was a 39% drop. That one right here off the divergent high into the COVID lows was a 53% drop. And where was the other one? Right here, I believe. And that one was still good for. I got to grab that top candle. Nope, I'm not on it. There, you can see the lines on it. And that was a 33% drop. So it means cut in third, cut in half. It doesn't look like it much, but that's what that is. A 50% drop means the company, the stock price was chopped in half. You can see it better when you go to arithmetic scaling. But those are real gains or real losses if you're in the position. All right, so again, identical technical posture, no sell signals, but I just want to point that out. And these are still the targets. And so basically the higher we go, as long as I can still make the case and I still have good convictions, which I do that we're going to hit those, it just means there's more to fall. That's it. And so, trade enough markets, it doesn't deter me to see this kind of strong momentum. I've seen it in other market conditions. And right now, again, if you're selective, you shouldn't have a full hard short on QQQ. I've been saying that for a long, if you even have a short position at all. You want to wait till the sell signal is great. Small caps, that's actionable. The semis are actionable. We had sell signal on stocks recently. But let me finish up here. So these are again, on the weekly chart, the ones that are, and I'm going through, remember, I'm doing this right now. I'm clicking on my watch list in order of market cap. And so these guys have the higher weighting on the indexes because they're larger, much larger. When I go through the top, I'm on the 3rd largest now, AMD. And you can see same old thing here. Divergence continues to build, still intact. This is our main divergence line all the way from back here. You can see it right here on the weekly chart. And Intel's not there. See, now you get to the point. So we went to the top 3. And this is, again, the components of XSD, the well-diversified semiconductor ETF, the S&P Semiconductor Index. NVIDIA, Broadcom, and AMD are your top 3, and they're at the highs. Then I go to number 4. Intel is still, I'm going to just measure from, I'm just grabbing where the highs were, and I'm measuring down to where we're at today. This stock is still 40% off its previous bull market highs. And this one is clearly in a bear market. It clearly broke back here. The primary secular bull market uptrend line put in a big divergent high, broke down, and it's nothing at this point, in my opinion, but a bear market rally. Either way, say what you want. What I'm showing you is the top 3 largest, and again, by far largest. Remember, NVIDIA was 1.6 trillion in market cap. When I get down now to the 4th largest holding in this ETF or sector, I'm at 182.8 billion, a mere fraction of the impact that NVIDIA has. Qualcomm, way off its highs right now. We're still 27, almost 30% off the highs. Texas Instrument, peak back here. So I can go down the list. Here's one that's recently at highs, ADI, Analog Devices. Remember, these are the top holdings, and you can see the primary trend lines. Now what I'm going to do is flip this around. I just sorted my watch list like this. There's the largest. We were going through those. Now I'm going to the bottom. And remember, these bottom tier, only the first few are at least several hundred million. Then we get down to the 1 billion. The fifth largest is still a big mega cap company. 1 billion, 1 billion, 1.3 billion. So I'm just going to go down, and I'll do it relatively quickly. I think you guys get the point where I'm going to go here. It's just like the NASDAQ 100. When you go down and exclude those top, 5 or 6 or 7 companies, and you look at the other 90 something, you're going to see a completely different story. You're going to see stocks that are in very much, most of them in bear markets. Many of those, the majority, not anywhere near new highs or all-time highs. All right, so this one is NVEC. We can go to the daily chart. Let's do that because this is a little more kind of near term where these guys may be going. So I don't have them all marked up. You can see that was a divergent high. Since then, the stock fell a total of 35%, and as of today, it's still down 21% off its 2023 highs. So this one's far from new highs. CEVA, that's a bear market all day long, a bear trend with zero evidence of a reversal, lower lows and lower highs. AOSL, again, you can just see these charts. I'm just clicking in order. It's just going down, and it's showing you the rest of the semis. So when you back out NVIDIA, AMD, and just a handful, you're looking at a sector, even with the big chip acts. And I know some of these may not be U.S. companies beneficiary of that, but you are seeing, and maybe they are. I don't know. I'll be honest with you. I don't know the composure of the S&P 500 or S&P Semiconductor Index, but you can see not a one of them so far. Here's one, CRDO, first one that's recently put in a new high. It's only been trading since 2022. Either way. Again, same story. These guys are down. A lot of these stocks are down. This one's down 40+%. And that's it. So this speaks to, again, when you lift up, pull the curtain back, if you will, what you see is just a handful of players that are, that you can't, discount how powerful the move has been. But what it is, it's just a crowded trade, and it shows you that if the overall health of the semiconductor sector, if the majority of companies are still entrenched in bear markets and not at new highs, it just goes to highlight, in my opinion, the hype into a company like NVIDIA. And NVIDIA, of course, is the leader in AI. That's widely known. But again, it's a very crowded trade. And at most points in history, when you've had this narrowing breadth, and it can take, and it often does, take years to play out. So it is, again, I'm going to leave it here on that same note. Negative breadth, negative divergences, overbought conditions, none of those are sell signals or reasons to be short. What are sell signals? Again, are breaks of support, breaks of bearish chart patterns, bearish reversal patterns, candlestick patterns, and things like that. So I'll wrap it up here. Let me make sure I covered what I wanted to cover. I've got everything. I hit the VIX. Yep, I got it all. Okay, guys, so that's it. And going forward, I'm going to watch, this is one of many I'll be watching, Meta. What else did we have last week? On Friday, we had Meta. Let me go to these guys. Microsoft. I'm just kind of recapping the Mag 7. Microsoft had a sell signal last week, and that remains intact. So remember, we have a check mark on Microsoft. Apple peaked here. Earnings are out of the way, and it's still below the post-earnings peak. That was a big divergent high right here. And again, Apple, lest you forget, was mentioned as a long trade here. But again, it was a short-term trade. It's something I took. I was in, out of. Same with and it's not, it's no different from any short trade that was taken a year ago. I just want to mention that because I keep seeing those repeated comments. So NVIDIA is up blah, blah, blah percent since you started talking about it as a potential short, and a Meta too. Remember, this is swing trading. I talk about the long term, where I think we're going, but in the very near term, it's these levels that I will trade off of that determine positioning. And so Apple, remember, Apple, again, I mentioned the other day, is objective long if you are bullish. That's a very good support level, 180 right there. And it hit the 200-day moving average. And so on Apple, as of right now, And I said it on Friday. If anything, you go long, you don't short, you wait till break of 180 and the break of the 200. So that's where you look at Apple. Other than that, I don't know. Next objective short. Maybe you've got a double top high here, about 198. We'll call it 200. I don't know. I'd just rather sit back patiently and wait for this to break. And again, I've said if you're long, and I said it back here, that overbought condition, that's where you buy it. And you may still be long, and this thing may go to the moon and beyond. Based on the technicals, I put, again, very good odds that it's not going much higher, that the next 20 to 40% move in this stock will be to the downside. I still have this long-term target I maintained for a while. Longer-term targets down here that are a lot lower. And this is the big level. That's why it's in purple. This primary uptrend line on Apple from the 2003 lows. We're getting very close to breaking it. But as I like to say, support is support until it's broken. So we'll watch that. And then all the other levels, go back to the daily chart. We've got some near-term levels, like Alphabet. I think I mentioned last week. I had an uptrend line, but I said there's your BOD line on Friday, 138.92. We'll call it 139. And I said intraday, we went through there, but it was an intraday move. So you have to break that on a daily closing or a solid intraday basis. Or I said basically now a break of Friday's lows. And so that's it. It's still above there. No sell signal, no check mark for Alphabet. Although it is down quite a bit from earnings. Amazon, divergent high, another one with a potential. I didn't look through here. There's a ton of gaps in this one. I think on Meta, that's a more clean and obvious exhaustion gap if we get it. And then NVIDIA. NVIDIA is NVIDIA. When everything else buckles, it'll eventually cave. And when the tide shifts, now guys, I don't know if that's going to, I think it'll be a lot sooner than 6 months from now or a year from now. But when the tide shifts, in other words, the NASDAQ 100 starts to clearly go down, starts to break support level after support level, and you get that snowball effect, you tend to see more hot air come out of the stocks that, had the biggest run-up, like NVIDIA. So NVIDIA, just as it's outperformed to the upside, will most likely underperform or outperform if you're short to the downside. So we'll just have to continue to watch it. And the longer you see that divergence in the semiconductor sector, the bigger the drop is likely going to be. There's Meta and Tesla. Tesla's just still sitting right on that 179.50-ish support, still below that trend line. And I said I'd stop, but I just remember I got a post out to you this morning, and I'm watching this. There's that euro. It's taking out that trend line. So this is a case of stocks not getting the memo. And it's certainly a temporary disconnect. Is there going to be a permanent disconnect between the strong correlation we've had between the euro, US dollar, and the stock market? I don't know, but I can tell you the euro has broken support today, is down pretty good. Stock market's not getting the memo. IEF bonds are down. That means yields are up. Again, well, I'm sorry, I shouldn't say that. Stock market's getting the memo today. I need to correct myself. It's down, but not down that much. 0.5% for QQQ, SPY 0.53. Neither of those are active short trades, but IWM is. And that's down 1.67 because that's a more interest rate sensitive. The small caps are more rate sensitive than the large caps. So they are getting the memo that Treasury yields are up again today. All right, guys, I will wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.